Now, we have a super panel for this discussion to pick up the baton that we have from the food play. We have, and I'll go from distant to near, we have Poppy Allonby, who is with the BlackRock World Energy Fund. Welcome, Poppy. We have Andrew Gould, who's the chairman of BG Group. We have Professor Sir Chris Llewellyn-Smith, who's the Director of Energy Research at the University of Oxford, and who I'm reliably informed put together the proposal to build the Large Hadron Collider, got it funded, and oversaw the start of its construction. So congratulations to you, sir, with the recent news. And I hope that means you know a thing or two about complex systems, which I guess is the flavor of this conversation. And then to complete our panel, I'm delighted to welcome Professor Ernie Moniz, who's the Director of the Energy Initiative and Director of the Laboratory for Energy and the Environment at MIT, and was the Undersecretary of Energy under President Clinton, who we saw earlier in the room. So, without any further ado, let's get into the meat of this, meeting our future energy demand. Chris, if I could come to you first, can you set the scene for our audience a little bit in terms of what the energy future demand is, where the drivers are, and perhaps what some of the variables are in trying to manage that, perhaps to do with managing demand, energy efficiency, or other pieces in that jigsaw. We'll come on to different aspects of the technologies with other speakers, but can you set the scene for us, sir?
Yes, certainly. But let me say first, if you look in the book, there's supposed to be another member of the panel, Marianne Hogue, but her flight was cancelled and she spent hours in Frankfurt Airport. She couldn't make it, unfortunately. So I was not supposed to give this talk, and you've got to put up with me. Marianne is a real expert on the demand side. I am not. So I've stepped in at sort of almost zero notice. What I'm going to say is a lot of it is in a briefing note. There are briefing notes on the website for this meeting on food, water, and energy, so you can go and get facts on that. So first of all, as the first speaker on energy, I'd probably make the obvious remark that energy is absolutely key. It's boring. It's a means, not an end. But without adequate energy, we're not going to tackle the water and food and other problems. So we heard from Hans Rosling the expectations of energy going up. And the question we have to ask is, can we do better than that? And the answer is, it's incredibly difficult. The International Energy Agency in Paris every year now publishes what they call a new policies scenario. And they look at all the pledges made by governments around the world. We're going to reduce our use of energy so much, this much less fossil fuel, blah, blah, blah. And they take them seriously, although the governments often have taken no steps to implement them and don't know how to implement. But the IEA said, let's see what you'd have to do to implement them. First of all, it's really tough. I mean, by 2035, they need 60% more hydropower, for example. Think of the civil engineering. But they say, anyway, let's think that happens. These are all the measures to reduce use, be more efficient, reduce use of fossil fuels. And the outcome is, by 2035, that energy use on this scenario goes up 33%, with fossil fuels up 23%. And more or less everybody thinks we're not going to do as well as that. If you look at BP's not business as usual, but realistic outlook, they think that by the earlier date of 2030, energy use will be up 40%. So energy use is going up for the reasons that Hans showed you, and it's mostly in the developing world, of course. The increase is, it's 60% increase in non-OECD, only about 1% in OECD, and that's good because it's driving development and lifting the 1.5 billion people who don't have electricity out of miserable lives. But that's the fact. Energy demand's going to go up. What can we do to reduce it? We can try to change human behavior, and price can drive that, but it's very difficult. There's even evidence that if you tell people how to save energy, the individual amounts are very small. And their conclusion is, I can afford to use more. I could cite you tests that have shown that. What you can do is better design of building, to use more natural light, cities, to use less transport, and so on. But that's slow, because the infrastructure's there. But the big opportunities, of course, in the developing world, where cities are growing very rapidly. How about on the efficiency side? Enormous gains are possible in principle. I think the IEA says we could curb the growth, or a lot of it, in principle. But and in fact, there's another famous graph of McKinsey that shows that the US could save something like a quarter of its CO2 emissions by steps, all of which save save money. So, and these are mostly, changing your light bulbs, better insulated houses, more efficient cars, more efficient electronics. Why is it not happening? And the reason is because individually these savings are incredibly small, and we're all too affluent. And we need regulation, particularly on buildings and cars, to drive these things. And again, there's a rebound effect. If you make cars that go 1,000 miles a gallon, people who were not using their cars because they couldn't afford the petrol may start using them more. So it's very, very hard. But we have to try, because the demand side and the efficiency gains in principle are the low-hanging fruit. Delivering them is really difficult. Now, I think you asked me also, Dominic, to say a little bit, to introduce something Ernie will say about renewables. So what are we getting from renewables right now? Remember, 78% is from fossil fuels. The IEA says we're getting about 10% of our energy from what they call combustible renewables and waste, but practically none of that is being renewed, as far as I know. The only serious renewable around right now is hydro, which is giving around 6% of primary energy. And the other renewables, geothermal, solar, wind, marine, they're at about 1.5%. So if they're going to take over from fossil fuels, they've got to go up a factor of 60. It's enormous, 60. And right now, despite remarks made earlier, they're small and they are a lot more expensive. Marine and geo are always going to be relatively small, but bio, in principle, solar and wind could go up, but we've got to drive down the costs and get them out there. And I think Ernie's going to say something about that.
Chris, thank you very much for that. I'm sure that will have provoked a few thoughts and questions from the audience. Do use your devices to push them through. Let's carry on with our first sweep of the panel to set the scene. Andrew, if I could come to you as a chairman of BG, perhaps on the fossil fuel side, on the oil issue, on the gas issue, and perhaps even related to some issues of fracking, which some people might be interested in. What's your take, if you like, from the traditional fuel space as we seek to meet these future demands?
So actually, I think the oil and gas industry is going through an era of huge change. And in fact, the magnitude of the task of supplying fossil fuels has got much more complex at a time when the industry is under societal pressures at a level that it's never experienced before. If you look at what's new, we're exploiting poorer sources of hydrocarbon, and that has brought us back on land, and that has brought us into full public and media scrutiny. If you look at general conventional land operations, a lot of the big activity today is in very insecure political jurisdictions or very remote offshore areas, and this has dramatically increased the risk in both cases. If you think what the position of oil and gas companies is in society, they have to face the climate change debate, which has polarized public opinion. And politicians, while increasingly calling for alternative energy sources, often ignore the associated costs of discouraging the oil and gas industry. And again, in the developing world, one of the biggest issues, it comes back to what Chris said about conservation, is the use of fuel subsidies, which is still huge. And finally, the industry has not found a common voice to present its position in society, and it doesn't defend its record. So if you look much to the disappointment, I think, of the peak oil club, there is no shortage of resource. In fact, technology and new methods are allowing known complex resources to be turned into reserves in production. And if you look at reserve additions over the last 10 years, onshore, the biggest single additional to reserves are tight oil and gas, shale oil and gas, and coal bed methane. If you look at conventional, which is the second largest addition to reserves, they are conventional, but they tend to be heavy. They tend to be in the Arctic. They are enhanced oil recovery, high pressure, high temperature, or gas with very high poisonous H2S mercaptan fractions. If you look at offshore, then the third biggest source of reserve additions is just classic normal offshore, fairly shallow water. And the next one is deep water, which is ultra deep, and in the case of Brazil and Angola, pre-salt. So if we look at the security risks, today in southern Iraq, when you go to the well site, you still have more security personnel than operating people. If you look at Sudan, it's virtually shut down. You look at Yemen, it's shut down. You look at Syria is obviously shut down. There are a whole series of countries that are marginal to the overall picture of oil production, but are nonetheless significant, where it's just too dangerous to operate today. If you look at offshore, we have the issue of pirates. All LNG tankers transiting through the Indian Ocean now carry armed guards. If you look at pressure groups, such as the Niger Delta, dissidents or people with a grudge have been known to operate up to 120 kilometers offshore using rubber dinghies with powerful outboards to board oil installations. And then again, if you look at the NGOs, we've had people hanging in baskets off the bottom of a rig that was drilling an exploration well in Greenland, which is not a very safe thing for them to do. And then if you look at the project complexity, it's Mozambique, West Irian. If you look at Brazil, you have to know that it's drilling through, it's 2 kilometers of water, 2 kilometers of salt to get through before you get anywhere close to where the oil and gas is. These are hugely complex projects. In the context of a post-Macondo world, where obviously the safety and emergency response plans have to take on a complexity and a nature that they've never had before. And all this is in a world when the oil and gas industry is desperately short of skilled engineers. And that's partly a generational thing, because during the long period between 1986 and 2000, when not much was spent on exploration and production, the companies didn't hire. So I now will close. I get the privilege of making some remarks about fracking. So firstly, if we look at the advent of shale gas in the United States, it's brought the E&P industry back into people's homes, into their backyards. If you, I wanted to show some photographs, but if you look at a satellite photograph of the Dallas-Fort Worth area in 1998, you see a nice piece of arid Texas terrain. If you look at it today, it looks as if the country has had a bad attack of smallpox, because there are thousands and thousands of wells in a very short, very small spatial area. And in that initial development of shale gas, which was largely done by independent operators in the United States, there was very poor planning and very little concern as to what public reaction was going to be. So what is going to happen? Firstly, as the larger oil companies move into the shale gas space, there is a movement away from using individual wells to using well farms, which allow much smaller surface footprint. Now, in the use of fracturing, up until now, fracturing has been used as a blitz technique. It's not very different from the way the Russians developed their oil fields before the 1980s. In other words, you frack as much as you can, and you hope that in fracking you're going to open up some gas to the wellbore. And the reason that this is done is because the classic petroleum measurements, equations that were used to calculate where the most productive zones are, do not apply to shale. Now, everybody is working on this, and eventually what will happen is that we will be able to identify the most productive parts of the shale. So instead of blindly fracking everything in sight, we will only frack where we know it's going to produce. And as a result, the size of the fracks and the number of fracks will eventually decrease. And actually, I think that if that doesn't happen, the shale gas industry in a place like Europe will just never take off. There are other things that need to be done to satisfy the operators and the public that these things are being done safely. Firstly, because of the use of fracking, it is very important to carefully evaluate the proximity of wells to natural fault systems or vertical fractures that exist in the earth. Because if you don't do that, you are creating the possibility outside the wellbore itself where you can have migration of either drilling fluids, frac fluids, or gas upwards towards the natural aquifers, which are freshwater aquifers, which are at much higher levels. And therefore, the measurements necessary to do that are going to become a part of the way to ensure that you don't have interference. And obviously, the bond between the rock and the metal pipe up which the gas comes, the cement, has to be absolutely impeccable, because otherwise you get migration through the annulus, which can lead, again, to either gas coming to surface or leaking into the freshwater aquifers. So, and those measurements as well will help to detect where you're likely to have local seismic events. Systematic capture of methane during production and flowback, and above all, greater upfront community engagement and education prior to exploitation. The IEA has just done a very good study, which is called Golden Rules for the Golden Age of Gas, in which they have calculated that doing all those things to make the whole process much safer would add 7 cents to the gas price. So it's not exactly something that is impossible to imagine. And I feel that if that's not done, it is going to severely limit the exploitation of shale gas overseas and possibly in the United States. I would say one more thing. There is a photograph which is horrifying, but you've all read about the United States tight or shale oil out of the Bakken. If you look at a satellite photo of the Bakken today, the Bakken is in North Dakota, where there are 780,000 people who live. If you look at the light intensity from the gas flaring in the Bakken, it is greater than the city of Minneapolis, where there are 2.2 million people. To me, this is a classic example of where the industry gets in front of itself and it doesn't realize that there are certain precautions that it has to implement if it's going to be considered at least environmentally conscious. Thank you.
Andrew, thank you very much for that excursion into fracking, but also a reasonably candid overview of the industry. Poppy, we'll come to you in a second, but it sounds like life is quite difficult in many dimensions, and I understand that much of your fund is in the oil and gas space, so I'd be interested in your thoughts on that. But first, perhaps Ernie, if life is a bit difficult in the carbon zone, then what's your take on carbon-free electricity moving forward, particularly with an emphasis on nuclear, which has also been in the news somewhat?
Okay, well, thank you, Dominic. What I will do is actually I'll make a kind of a series of declarative remarks emphasizing confidence over accuracy, perhaps, in these various remarks. Now, we've all heard, of course, that how climate change risk mitigation combined with 9 billion people is kind of the preeminent challenge for the energy system. I just wanted to note that if we take Mr. Rosling's toilet paper, light bulbs, and washing machines and do the math, it's really 3x on electricity in 50 years. That's the scale that we are talking about, and of course doing that in a decarbonized fashion. I also would say, as a preface, that I certainly believe that the solution will be technology and not policy led. We can debate that. I would also add, following Chris's remarks, that demand management must be an essential component of any credible solution. But now let's turn to this issue of the electricity sector, which in fact will almost certainly be the lead in decarbonizing the supply side, because the cost of the marginal ton of CO2 removal is much, much lower today, certainly, than in the transportation sector. So what are the options? Nuclear, renewables, hydro, wind, solar, geothermal, biomass, and carbon capture, utilization, and sequestration, CCUS. So there is also one other, of course, bridge to a low carbon future, and it's a bridge, and that is the natural gas substitution for coal, which, following Andrew's remarks, as many of you know, is a remarkable story in the United States, with 1/3 of coal being displaced by natural gas in the last few years. And when you realize coal constitutes 75% of the electricity sector carbon emissions, this is a big deal, with some lessons. First of all, the marketplace is much more effective at implementing large changes which politics can't achieve. And secondly, it's much easier to scale when you have your supply chains in place than when you're introducing new technologies. So let's turn to nuclear. There are multiple challenges. I'll say a few words about them. First, cost. We should first emphasize that our typical discussion revolving around theological calculations of levelized cost of electricity really is not as helpful as separating capital costs, which kind of determines your needed investment returns, et cetera, and marginal cost, which determines whether you dispatch and in fact have a revenue stream to collect. In that context, nuclear, high in capital, low in marginal cost. For a scale, and we can argue this, but I would say a nuclear project today, we're talking about roughly $7 a watt of capacity, where fuel costs are well less than 1 cent per million BTU. So with that structure, in a market situation, it'll be difficult to build nuclear plants because of the high capital cost. In other situations, China, a regulated part of the United States, we in fact see 65 plants under construction, and if you build it, it will produce electrons essentially all the time and have a clear revenue stream. Safety. First, we need to distinguish, I would argue, between an externally triggered event such as Fukushima versus the kind of engineering operational failures that we saw at Chernobyl, 3 Mile Island, and the like. And frankly, with Fukushima, I have to say one thing. It is shocking to me that we have seen this mentioned many times, I don't mean this morning, but other times, with never a mention of the 20,000 people or so killed in the tsunami relative to the impact, the direct health impacts at least, of the nuclear meltdown. Now, that's not an excuse. And furthermore, the fact that the failure to plan for that tsunami in that location is a shocking regulatory failure should not be a comfort for nuclear advocacy, since these human systems, frankly, in my view, are a greater challenge than the engineered systems, especially as they are evolving with new nuclear technology. So good regulatory design and ruthless execution are critical, especially as nuclear expands to new entrant countries with very small programs. This is happening, it will happen, it's not going away, and so the major nuclear power countries really have a responsibility both internally and externally to work on this. The last set of challenges, waste management and proliferation risks, I will not, because of time, I won't really address them, but I will just say that the failure to adequately implement, not for scientific reasons, but for other reasons, waste management systems is also constraining our ability to address non-proliferation, because one part of that would be, in fact, the return of spent fuel to countries of origin. Let me just say a few words on solar. First, I'm very bullish on solar over time, and I believe many will be surprised at the degree of scaling that will occur, at least to some level, even as subsidies recede. Having said that, we also have to be realistic. Today, the best utility PV photovoltaic projects are down to around $2 a watt. We could go maybe a little bit lower. Now that sounds low compared to the $7 a watt for nuclear. However, we should correct this by capacity factor. And when you do that, the effective comparison is really $12 a watt. That's really, I would say, more the reality, coming down, but it's still pretty expensive even in the utility context. And that is before adding any costs for storage, non-dispatchability, and or need for dispatchable backup and capacity payments in the system. So we have a ways to go. I remain very bullish, but we have to realize that innovation is still required to move this forward. And finally, let me comment briefly on carbon capture, utilization, and sequestration as the other major carbon-free pathway. This is about making the world safe for coal. Many of us maybe would not care about making the world safe for coal, but it's a reality. China is heading to 750 gigawatts of relatively new coal plant, which themselves will account for about 5 gigatons of CO2 per year, double the target for the entire energy system of the world in the discussions around 450 ppm. So we have to address this one way or another. They're not going to leave all that cash on the table in these next decades. And without getting into detail, we can, in the discussion, the European and US programs today and over the last decade, in my view, have been a total muddle, wasting time, waiting for companies to magically appear with $1 billion on the table with no carbon price and no promise of a carbon policy. It's really insane, and I could describe other ways of approaching it. So with that, I'll just conclude by saying that we just touched here upon 3 carbon-free technologies, but in general, picking one of these or others, I think, is a big mistake. We will need a portfolio over space and time, and a good example would be, think of regions that are supplied principally by carbon-free electricity or by coal. The technologies you want are totally different. Building efficiencies and LEDs, et cetera, in the former don't gain you any carbon. They do if you're supplying coal. Electrifying transportation in the former makes a lot of sense. You displace oil by carbon-free electricity. It makes no sense in the coal region if you want to lower CO2. So we need to really think about this portfolio and support innovation across a broad range to get the cost reduction, which I believe will be the best pathway to eventually putting in place a CO2 emissions price.
Thank you so much. It's such a shame that we can't kind of just spend the whole day kind of working through this, because there's kind of issues and thoughts and observations coming from this panel, which I know will be triggering some thoughts and reactions from the audience. Just pick up on a couple of things. I was taken with your comment that solutions will be technologically, not policy-led, which you said at one stage in your overview. And there's a question that has come through. This thing is working, so do type in, about, rather unsurprisingly, how important is a price on carbon for large-scale investment, i.e. a policy-led initiative. So if you ponder that, and we can maybe come back to that, because this sort of is an interesting area, this mosaic approach, a bit more modular, different technologies, different activities for different regions, but here's an umbrella, if you like, policy instrument. So exploring that, which obviously had some resonance with the earlier discussion around these coalitions and collaborations. Poppy, we heard from Andrew about the trials and tribulations a little bit in the oil and gas sector, and you've heard a wonderful exposition from our 2 academic friends here. Are you feeling more comfortable managing your global energy fund or less?
Hello. I'd like to first comment maybe on some of these low carbon alternatives, and certainly from an equity investor point of view, this has been an extremely challenging place to make any money. In fact, it's been extremely painful over the last 2 years. So let me just frame that, to put it into context. If you had bought the shares of the largest wind turbine manufacturer in the world a year ago, you would have lost 80% of your money. If you had invested in some of the largest solar manufacturers in the world, in just the last year, you would have lost 60 to 70% of your money from an equity point of view. So the sort of track record, certainly in the recent past, has been incredibly difficult. So the question to ask is really, why is that? And what can people do to address that? And I think there are several reasons. The first is there's huge regulatory uncertainty. So when you look at this is particularly true in developed markets. So you look at the EU, and clearly the fiscal challenges are immense, and consequently there are huge questions about the sustainability of some of the subsidy programs in place. And you turn to the US, and the US does not have a credible long-term energy policy. And some of the measures that have been put in place to support some of these new areas like wind are very short-term in nature, and in fact the primary subsidy program for wind expires this year. I think the other kind of key sort of short-term headwind is there's actually been over-investment in this industry. Now, there might be many of you in the audience that sees that as a good thing, but from an investment point of view, if you've got factories sitting there running at 30% capacity utilization, that is not a comfortable position to be in at all. And I'd say the sort of last headwind over the last couple of years has really just been the economic backdrop, because in a very weak economic environment, there's little need to build any new power generation, certainly in developed markets, whether it be coal, whether it be gas, or whether it be renewables. But I don't want to be too bearish, because I think on the longer term perspective, there are reasons to be optimistic. And like Ernie, I'm actually very optimistic on solar. And the reason is because although costs are still high and it's still dependent on subsidies, costs have been falling very quickly. So just since 2009, I mean, this is only 3 years, the cost of buying a solar panel to put on your roof has fallen by over 70%. So if you keep that pace of cost reduction very quickly, using Ernie's numbers, you start to get into a realm where solar can actually compete without or with far less subsidy support. And that could open huge markets up, and I'm thinking particularly of areas like China. The other area I'm optimistic on is gas. And I think the US has a huge opportunity here of having very cheap energy, and one that is relatively clean, certainly relative to the coal it is displacing. And I'm optimistic that the US will find ways to use that, whether it be in vehicles. I mean, the US is, there's a company actually currently building 150 service stations to actually help cars and trucks power on gas rather than on gasoline. Or whether it be through exports, and Andrew's involved in some of the sort of export-led projects there, or whether it be involved in sort of industry and petrochemicals. So in the kind of funds that I manage, excluding actually our investments in oil and gas, and I look at these alternatives, we've really actually stepped back from investing in renewables from an equity perspective. And we've more focused on some of the problems around energy infrastructure, energy efficiency, so picking up on some of the remarks earlier about how do we reduce energy usage, and also looking at some of the global gas dynamics.
Very much, very interesting. There's an awful lot to pick through here. One thing that does strike me, and it perhaps relates to this question of carbon tax, a policy instrument, does that work? If we perhaps broaden that out about changing the relative cost structure, which was a phrase that was raised, I think, last night at a dinner, and subsidies were mentioned in that domain. These could be instruments that could be played by governments in terms of changing that relative cost structure. You mentioned the need for a long-term planning, so there was a call for policy over there. But let's stick with the cost structure issue. Maybe if we can sort of just take a feel on that through the panel. Ernie, how do you feel about this?
Well, first of all, by the way, I mean, a good, clean material CO2 price would clearly be a major mover, and I think that's where we have to go. I'm just very skeptical that we are going to go there globally. I don't mean in the EU. I mean where the CO2 is or is coming until we get the cost increment lower to provide the courage for the policymakers to step forward. Ultimately, we need a CO2 price that's clean, preferably economy-wide, and without all kinds of gymnastics.
Chris, what's your take?
Well, first of all, I agree with that, but the first thing to do is remove the subsidies for fossil fuels. $400 billion a year for subsidizing fossil fuels. And the justification for that that's given is this is helping the poor. But according to the IEA, from whom I took that number, only 8% of that goes to the world's poorest 20%. It's a colossal subsidy for us in this room, the better off people. It's very difficult to get rid of it, though, because there's huge vested interests out there. It's hard, but we've got to try to do it somehow or other, while protecting the people for whom it's designed. So I first think get rid of the subsidies. And after that, yes, a carbon price, that would have a big effect, obviously, but it's very, very difficult to do. And I personally think maybe we should be doing it unilaterally, let's say in Europe, and then putting in tariffs for people, for areas that don't have carbon taxes, which should be seen, the absence of a carbon tax should be seen as a subsidy for destroying the planet, and we should be taxing them to bring them up to our level. This is an idea developed by Dieter Helm and others in a paper that's still in press. So I think, and we also need subsidies as launch aid to help the renewables off the ground. I won't say much about that because there's a session on it later this week, but that's very difficult because once you've got the subsidies, the vested interests want to keep them. You've got to have a way of getting rid of them. And you've got to announce in advance you're going to phase them out. And in all of this, the subsidies and the carbon price, stability, that's what investors need. That's why I'm in favor of a carbon tax rather than cap and trade, personally. Because you're not going to invest if you think this may or may not be the cost. You need certainty.
Andrew, how does this make you feel? Are you kind of worried about stranded assets in your head here? Or?
No, I step outside my oil and gas, pure oil and gas role. I think that the whole issue of rent and subsidy is completely dysfunctional. And if I can give you two examples. So firstly, the state of Italy makes more out of gasoline than Abu Dhabi every day because it's taxed. I know what the tax is in the UK. The only market where there is a pure flow-through of oil price to consumer is the United States. In Europe, all the governments are in between with very large vested interests in the amount of tax that they draw from it. The second one, which to me is an absolute classic of how these things have become dysfunctional. The displacement of coal by natural gas in electricity generation in the United States has freed up large amounts of thermal coal on the eastern seaboard. And as a result of that, two major European countries, one of whom is the UK, the other shall remain nameless, in the first quarter of this year, the biggest increase in their generating fuel was coal. And even coal, with a carbon price such as it is, was not a deterrent to using coal to displace gas. So, I don't have a solution, but I do think we need to recognize that the whole system of rent and subsidy, as it works today, is very dysfunctional.
Poppy.
From an investment point of view, I'm very ambivalent, and the main thing that sort of counts is to have some stability, and that could be in a subsidy program, it could be in tax programs, but I think that's the key thing that from an investment point of view investors look for.
This is following on Andrew's statement about the rents and subsidies, which I completely agree with. Poppy, you earlier said the United States does not have a credible long-term energy policy. I agree with you. However, I would agree with an inference that others do.
Oh, absolutely.
So, including complex Rube Goldberg structures of rents and subsidies, and frankly, unrealistic aspirational targets that pose as policy. So.
Interesting. This is why I said if we get kind of like another 20 minutes or so on this, you could dig into some. There's one more question that came through, and I'm going to play that through the panel. But I also want you to be thinking about, to leave our audience, so what would you do? What is to be done? The other question that cropped up, which was quite interesting, was about gas and cheap gas basically killing innovation in any other play. And energy efficiency was mentioned, because we haven't really talked about that. So the flood of cheap gas means that we can get lazy. We don't need to really innovate or think about other areas. I will start from the other end for you. Ernie, Poppy, how do you feel about that statement?
Well, I'd clear up the fact that gas is not cheap everywhere. So this is unlike oil, which is fairly fungible, and we move it around the world, and you might have the odd difference between US.
Let's take the US then, for example.
So it's a pure, this phenomenon for cheap gas is purely in North America. Right. And I would agree with some of the comments that certainly the biggest impact of cheap gas has actually been on the coal industry. And there were already some comments talking about what has happened. And this week we actually saw one of the US coal companies file for bankruptcy because of this very challenged environment. So I don't think certainly outside the US, I don't think there's any cause that it should reduce innovation.
First holds that in the US it might.
In the US it might, yes.
Andrew?
I think you have to be very careful in assuming that the gas price in the US is going to be as cheap as it is forever. We're in an overproduction situation at the moment, which is caused by two things. Firstly, by, what did Alan Greenspan call it? Irrational enthusiasm. And secondly, by the fact that the US is a closed market. There's nowhere for the gas to go. They can't export it. But I would not assume that the gas price is eternally going to stay as low as it is. And I think that I actually am a firm believer that to the extent that as an interim measure, the world displaces the use of coal with natural gas, it's a good thing for everybody. And gas, while they say there are 250 years of current reserves, if we have the sort of growth, current reserves at the current level of production, if we have the sort of growth that was mentioned this morning by several people, gas is not going to be eternal either. So I don't think it's going to gravitate to a price, as Poppy said, on a world basis that's sufficient to discourage innovation in other fields.
Come to you, because you'll have the final word on this whole panel, so if you hold that thought. Ernie, cheap gas in the US for now is killing innovation.
I agree that the gas price is going to go up, although it may take a further dip this year before the winter, but then next year it'll go up modestly. But I would add another feature to the overproduction, Andrew, as you well know. A number of producers are responding rationally. They're moving their rigs away from dry gas. The trouble is all that wet stuff is producing a lot of gas as well, and the shale oil. Exactly. So that's the one point. Secondly, going to Poppy's point, which is very important, we often forget that the market structures for gas are so different in different parts of the world, and it's only cheap in the United States. On the other hand, that huge price gap, let's say, between the United States and Asia, is not all about geology. There are contract structures which need to be revisited that could change that equation a lot. Third, I think that this question that you raised, Dominic, about gas kind of squeezing out innovation, I take a different view of it in the United States. I would argue, we've reduced CO2 6-7% as a result. I prefer to look at it as buying us some time, which of course is only useful if we use the time. That's the problem, that we need to use that time to carry out the innovations for the carbon-free alternatives, because otherwise we will have the classic bridge to nowhere.
Bridge to nowhere. Right. Okay, so we're going to kind of land this. I'm going to start with you, Poppy, and end with you, Chris, on so what would you suggest should be done? Our exam question here was meeting future energy demand. Give us a clue. Where would you say that we should start, Poppy?
I think the easiest savings are in energy efficiency and reducing overall energy demand.
Okay. With the worry that innovation in energy efficiency is not necessarily going to be happening in the US unless we have this mindset of this is buying us some time to invest in that innovation.
I would never say that the US will not innovate. I disagree with that statement. I just think that the challenges, even with a gas price double where it is today, which is where the futures market is, incidentally, will make it slightly more challenging than in other markets.
Andrew, energy efficiency is on the table.
I completely agree. I mean, Ernie and I were both involved in the National Petroleum Council's report to the previous administration in the United States, and the number one finding from the oil and gas industry itself was that energy efficiency is the best way forward.
it seems to be energy efficiency. Agree, disagree? And if you do agree, then how do we get beyond just talking about it and seeing something happen at scale?
Well, I would say demand management, as I said earlier, is a significant progress on demand management, which I want to emphasize is not the same thing as efficiency, is a necessary but not sufficient condition to address the climate challenge adequately. And so I will just, without arguing with that part, I would say that we still need to pick up the pace, as I said, for cost reduction on zero carbon options across the board.
Chris, final word.
Okay, let me just first go back to the gas question because you skipped me. I agree with everything that was said, but the implication was the effects are in the US, and of course that's not true, as the panel knows. In this country, 3 or 4 years ago, we got no gas from Qatar. Now it's 27%. And those were terminals built to send gas to the US that doesn't need it. So this has had a huge knock-on effect, particularly on the security of supply. We have a completely new source. And a lot of that's even more than we're the biggest single user in the UK of Qatari gas, but a lot's going to the east. I agree about efficiency and demand, but let me just try to sum up what's come out of this panel. I think there's only 2 firm predictions we can make. Demand's going to go up, and that we're going to become increasingly electrified. I think that's common ground, and that's the right way to go. Technically, I agree with Ernie in that technology is the solution, but I don't agree that policy, I mean, it's got to be driven. Policy can drive it. I do agree about targets. I mean, our governments make targets, no idea what it means to implement them. And if they're missed by a large amount, that can be very counterproductive because it can undermine the whole thing. There is no silver bullet. We need to improve the technologies for efficiency, for distribution that we haven't said much about, and for production. And the production is going to be a mix, which is geographically dependent, as Ernie said. Beyond that, to drive the change we need to remove the subsidies, $400 billion a year. We need to get some price on carbon, if we can, though it's very difficult, as Ernie emphasized. And we probably do need subsidies very carefully done as launch aid and more R&D. A higher carbon price will drive innovation in the private sector, but there's a lot of long-term things which the private sector won't do. And the publicly funded R&D is $25 billion a year at the moment worldwide. In real terms, the same as in 1981. Well, the market's gone like that. It's totally crazy. If some of that $400 billion could come away from fossil fuels, some go into more subsidies for renewables, which are about $65 billion at the moment, and more R&D. We've got to get better and cheaper technology.
Okay, thank you very much. And thanks to those of you who put those questions. I'm sorry we couldn't do more than we were able to float to the panel. There's some great kind of questions. I might actually share them with you and see if we can't connect up. We're going to have a short break, 5 minutes or so, then we'll complete the trilogy with water. There were some very well-rehearsed discussion points here, but I do feel that there was something interesting about sequencing and about this technology and policy interplay and which comes first and how they react together in a more modular sense as opposed to one size fits all. And I think we'll pick up some of those themes as well as the biofuel issue in the water panel. If we could give a round of applause to our panelists who gave a very interesting conversation. Thank you very much.